welcome everybody. This is to the relaunch of the International Lending webinar with CEPR. My name is Christoph Trebisch. I'm organizing the seminar. I'm at the Kiel Institute for the World Economy and currently visiting Stanford. It's a great pleasure to welcome Karsten Müller as the new opening speaker of our webinar. Karsten and I go a long way back. He has skyrocketed from, I first met him as a PhD student in Warwick, and since then has made a stellar career. He first went 3 years to Princeton after his PhD at Warwick, and then is now at the in Singapore at the NSU. And he has worked in various fields. I best know his work on macro finance, on international finance, including this paper, which I very strongly recommend. He has published very well, including in top 5 journals, JEA, in finance journals. So in a short period of time, he has really produced an impressive body of work. Great to have him here. He is presenting a paper that I very much like. I've seen it at the NBR Summer Institute. It's called EXIM's Exit, The Real Effect of Trade Financing by Export Credit Agencies, and it's joined with Adrien Matray, Chenzi Xu, and Poorya Kabie. Yeah, the rules of the game are we have a 45-minute presentation, 40 to 45 minutes, and then we have a Q&A. Usually there are no interruptions to the presentation. Just in case of very urgent question, of course, feel free also to use the chat. The Q&A usually works in person, so people can actually join in with their camera or at least with audio, so it's more interactive than just via chat. But you can also ask questions via chat if you want, but the preference is that you come in and just raise your microphone, so we let you in. Okay, with no further ado, Karsten, the floor is yours. 40 to 45 minutes. Thank you so much for doing this, despite this being late at night in Singapore.
Thanks so much, Christoph. I really, really appreciate the opportunity to talk a bit about my research. And, this is really the honor and the pleasure here is all mine. So let me just go ahead and share my slides, and then would appreciate a quick thumbs up from you if you're happy with what you're seeing. Perfect. Okay. Well, thanks again for having me here to present this paper with Adrien, Chenzi, and Poorya. And the motivation for what we are interested in here is the fact that export credit agencies, or ECAs, are kind of a really important component of industrial policy today. And so if before this talk, even if you're an economist, you have never heard of what is an export credit agency, I do not blame you. Before starting to work on this project, I also did not really have much of an idea of what that could possibly be. So let me try and give you a bit of a sense of my current understanding. So export credit agencies are usually public, sometimes semi-public institutions that aim to increase a country's exports by supplying trade financing, making trade financing hopefully more frictionless. And what is important is that these export credit agencies are really ubiquitous. They operate both in advanced and emerging economies, and all major exporters have them. And as a result, basically most of the countries accounting for global trade also have one of them. Now, it turns out that this market is really pretty difficult to estimate in terms of its size. In fact, so we're working on some follow-up work where we are trying to do that more thoroughly. But the current estimates that we have are that export credit agencies back something on the order of 1 to 2% of global exports. Now, as I said, the important part here is that when you hear export credit, I want you to really think about this as a type of industrial policies, because this is a way for countries to try and get your exporters to do better and better relative to your kind of global competitors, and at least to two estimates that we have, the main one coming from this recent paper here by Rika Juaj, Nathan Lane, and co-authors, is actually the most frequently mentioned type of industrial policy around the globe today. Now, what's kind of really open here is what is the impact of these export credit agencies? And hopefully there's also something we can learn perhaps more generally about the economics of industrial policy. And we're going to be studying this in the context of the US Export Credit Agency, which is called the Export-Import Bank of the United States. In 2015, on July 1st, the US Export-Import Bank suddenly completely shut down its operations. And this is kind of a major shock from the perspective of US exporters that we're going to be exploiting to think about the impact of these export credit agencies. I'll tell you more about the exact context later. What is important is that the shutdown period was essentially relatively short in 2015, and it was prompted initially by political bickering in the United States, for lack of a better word, where the Tea Party movement at the time made it kind of one of their goals to get the authority basically shut down. And so, the way to think about this is that this is really a major government agency that just closes from one day to another, basically because it didn't get its charter renewed that had been in operation since the New Deal. What is actually perhaps somewhat more important for us is that even after this initial short shutdown period, the EXIM remained basically barely operational, because in order to get most transactions, most trade financing transactions approved, the US EXIM needs a board quorum, meaning that it needs to have a sufficient number of board members to approve these transactions. And because of partisan gridlock at the time, this was basically not happening, because the Republican senators were basically blocking every nominee put forward, such that the effective shutdown here really was from 2015 to 2019. Now, the easiest way to see the effect of this specific shock we're going to be looking at is to just plot the total value of new financial support by the US EXIM over time. And so here, when I say financial support, I mean, I'll get into this a bit later, both direct lending to exporters, which is very small, and more importantly, loan guarantees and loan insurance. And what you can see is that essentially immediately after the EXIM shutdown, this total value went to precisely zero, right? So in the quarter immediately following the shutdown, if you previously had relied on EXIM support in any way, now you could get exactly zero support. And then we see, after this immediate shutdown period, when that I mentioned, there's this longer period where EXIM did not have a functioning board. And so as a result, it couldn't really approve any large transactions. It could only continue to provide small transactions. And basically, because of that, we see, there's some kind of recovery, but it's very clear from this picture that, this initial shutdown and the period after that essentially is a really major shock to trade financing coming from this institution. Now, what's important is that both when we're looking across firms and when we're looking across industries or product categories, there's a lot of variation in how much firms and industries and products relied on this kind of trade financing support before the shutdown. And this is what's going to allow us to, essentially set up a standard differences estimation where we can compare more or less exposed firms, more or less exposed industries before and after the shutdown, where under some identifying assumptions, we think we can then study what the impact of these export credit agencies is on not only exports, but also other firm and industry outcomes. And just to give you a couple of examples here, right, you can see if these numbers are in percent, that there's really a massive variation, right? So for example, oil and gas extraction is one example. Barely relied on these kinds of subsidies, right? If you look at, for example, textile mills, right, some substantial fraction of EXIM financing was quite important for backing exports in that industry. And so in this paper, what I'm going to be doing is start off with a very simple question, which is, did this shutdown of the US Export Impact Bank affect the real economy? And how I want you to think of the null hypothesis here is that in essentially two ways. So the first is, when you think about an individual firm, you might say, well, export financing, trade financing, we know that exporters tend to be larger firms, they're productive firms. Any kind of trade transactions that they're doing, right? They surely, they're already doing everything they can, right? There are no kind of, these are relatively unconstrained firms. Why do they need this kind of support from the government in the first place? And so, essentially the null hypothesis here is that, look, this EXIM support is a pure profit windfall. All the firms do is they take that money, they pocket it, and, they basically just, are artificially more profitable. And that's the end of the story. They're not going to react. They're already doing all the export transactions they want to do. When you think about more the, economy-wide, or I say the industry level, the null hypothesis that we're interested in is to say, look, even if it's the case that there's any effect on the firm level, it is simply going to, what's simply going to happen is you take away this kind of subsidy from one firm, and then you give it to another firm. And so, there's not going to be any aggregate effect. All that's going to happen is that, the firms that are artificially large or that artificially export more because of the subsidy, they're going to shrink, then their competitors are going to export more. And on that, there's not going to be any effect. I'll show you some empirical evidence that rejects both of these hypotheses. So on the firm level, I'm going to show you that the EXIM shutdown led to a decline in exports, in overall revenues of the firm, in investment, and in the number of employees. And I'm going to show you some complementary evidence on the industry level, where I'll show you a pretty large elasticity, where essentially 1% decrease in financing is associated with a larger than 1% decrease in exports. On the second part of the paper, I will then try to walk you through the following question. So, okay, taking away this kind of subsidized financing affects firms and affects industries, that's fine. But perhaps this is simply because it was propping up firms in the first place that really shouldn't have gotten this kind of support. And so, perhaps what we might see in the data is that, yes, these firms are shrinking, but that actually improves the allocation of capital in the economy, because now there's no more government intervention that's preventing kind of an optimal capital allocation that you would have in the absence of these policies. And so I'm going to show you some evidence that this is not true in our context. So in particular, what we find is that investment or capital actually contracts more for firms that had a higher marginal revenue product of capital in the pre-period, which is kind of a standard test that has been used in the literature to suggest that, if anything, the misallocation of capital in the economy went up after the shutdown, not down, suggesting that it was not the case that the trade financing provided by the US EXIM was leading to a misallocation of resources. Now, the last part of the paper, I want to talk a little bit about a framework that we think can rationalize at least some of these results, because I think it's interesting and important to think about this not only in the context of the specific setting that we study, but also more broadly when we think about, a lot of countries seem to be doing this, right? So how should we think about the economics? And perhaps that's also something we can learn more broadly about the economics of industrial policy. And so in particular, what I'm going to highlight is a model where we essentially have two kinds of frictions that we think can give rise to a rationale for government intervention in trade financing, which is some kind of financing constraint on the part of the exporter, and cross-border frictions in the sense of, I'm sitting in the United States and I want to ship something to Algeria. That might be more complicated for a variety of reasons than if I'm shipping something to Canada, or I'm only shipping something from state to state. Now, the existing literature, I think, has essentially tried to look at related questions in a variety of ways. So I don't want to spend too much time here, but to say that we think that essentially we are, what we're doing here and contributing is to really think about the economics of these export credit agencies to the best of our ability, and provide some hopefully reasonably convincing causal evidence that these agencies and support by these agencies has real effects. And so, in particular, what we'll be speaking to here is some literature on export credit agencies in particular. A lot of this work is just correlational nature, but there's also a larger literature on finance and trade and misallocation, and of course, on the design and effects of industrial policies. So with that, let me try and get started here by telling you a little bit more about the institutional setting that we have that we think is interesting for thinking about export credit agencies. So the mandate of the Export Impact Bank of the United States in particular is to support jobs in the US by facilitating exports where the private sector is unable or unwilling to provide financing. So it's a very kind of, a clear mission statement in some ways that aligns, I think, quite well with an intuition we get from the literature on trade financing more broadly, that highlights that, if you're trying to export things across borders, there's a lot of contractual frictions. If you're trying to finance such transactions and you have to be worried about whether people actually repay you that are, buying some machinery in a faraway country, things get even more complicated. And I think that's quite in line with the explicit mission of the US EXIM. Now, what is it that they do in practice? Mostly, they insure lenders against payment default and provide loan guarantees. They also have a smaller program where they provide direct loans, working capital loans to exporters. And so what's important here and kind of an interesting institutional detail about this export credit market generally is that these transactions or these activities, they really finance not so much the exporters directly, but rather what they finance is a US firm wanting to export something to, say, Algeria. What they're going to do is they will lend to the Algerian firm. And basically, in case the private sector doesn't want to take that kind of risk because of the above-mentioned frictions, the US EXIM will then insure a private sector lender against the potential default risk. One way of doing it is basically, straightforward insurance contract. The other one would be with a loan guarantee. So, how you want to think about this is that the loans are not going directly to US exporters. They're going to their clients abroad. And so it turns out that this kind of structure is, very common in the export credit market. Now, what's also interesting is that EXIM operates under pretty tight, I would say, operational constraints. They have to be subsidy neutral. This is governed both by WTO regulations, by the so-called OECD arrangement on export credits, and also the US Federal Credit Reform Act. And so what that means is that basically EXIM's marginal revenues have to be larger or equal to its marginal cost. And so as a result, perhaps, the EXIM actually has a very low default rate that is in fact capped at 2%, which is set by Congress. And if you look at some data on the profitability of EXIM, you will see that typically the US EXIM is actually profitable, meaning that it's not something that has to be kind of financed by taxpayers, but it actually returns money to the Treasury each year. That's a kind of typical scenario. There were some years where they faced losses and got under fire for that, but on average, EXIM is a profitable institution. Now, let me just say a word on the data that we're going to be using that's going to allow us to really exploit this institutional setting. So the most important data perhaps is that there was a FOIA request asking for every single transaction backed by the US EXIM to be publicized. And so it's this FOIA request that essentially gives us a registry of all individual loans with any US EXIM involvement. And so what we have here is, the coverage of 2007 to 2022, so kind of nicely overlapping with the shutdown of EXIM in 2015. And what we can see there is both the export product, but also the firm name, meaning the US exporter that is involved in this transaction. And so basically, that is what we match every other data set here on. And we're trying to be as careful as possible in identifying firms correctly. The other data set that we use is the Bachi version of UN Comtrade. This is the standard trade data set where we can see bilateral trade going from the country, product, and year level. We set up a panel here from 2010 to 2019. And what we're going to be looking at in particular is the US and a set of other similar developed countries. We just follow the work by David Otter and others, where they kind of set out a set of comparable countries. For firm outcomes, we're going to be relying on CompuStat, so publicly listed firms. That's something important, I think, when interpreting the results that I will also come back to later. Again, we get a panel 2010 to 2019, and in the baseline, what I'll show you here today, we're going to exclude Boeing. We're going to exclude them because Boeing is one of the major recipients of EXIM support, and it's been studied by a recent paper by Effie Bendelik and João Monteiro. Now, everything that I'll show you will look exactly the same if we include Boeing, okay? So we've been a bit back and forth whether to include it or not. One more thing that we have is we have the universe of maritime exports from a commercial data provider called Datamine. It's also been used in some other research. And what is nice here is that this data set gives us a firm product destination level panel. So it means I can see, okay, I have one firm, it's exporting several products to many different countries. And so that kind of variation is going to allow us to really think about the kinds of frictions involved in cross-border trade and the effect of trade financing. So let me start here by showing you some evidence on the real effects during this EXIM shutdown. And let me start with the US product level export. So think of this as kind of, we're comparing the US-wide products relative to products in other countries and other developed countries. Now, the exact regression that we set up is the following. What we're interested in is export growth at some point time t relative to the year 2014. So this is before the EXIM shutdown. And we're going to be setting up this panel at the 6-digit product level. The variation here comes from products, origins, and destinations at different points in time. So the US exports to different countries, different products, and at different points in time. What we're going to be doing in particular is we will look at changes in these categories, which is kind of the same thing as just putting in a full set of product, origin, and destination fixed effects. And we're going to construct a measure of how reliant was a particular US product on EXIM support by scaling the amount of dollar in EXIM support that went to this kind of product category relative to its exports in the pre-period. And we'll interact that with a post-dummy, and this gives us kind of a continuous version, generalized difference in differences estimator, although in the paper we show that you can set this up in many other ways, and you'll also find similar results. Now, what's important is that in the specification, we can put in a full set of product destination year effects. And so that means, for example, if you're worried about a tariff shock that affects different products, or different products going to different places, that will be completely absorbed by this level of fixed effects. And the same is true for any kind of US specific changes in regulation that just affect all products in the same way. So these are the origin times year fixed effects. And so our interpretation here is basically this coefficient beta gives us the effect of the EXIM shutdown on exports net of any business ceiling among firms, because this kind of aggregate product level exports is not just an individual firm. I'm going to skip over this part here, but we also try to do a little bit better than some other work in constructing our dependent variable by accommodating entry and exit in different products. So countries can kind of stop exporting particular products to particular destinations at any point in time. That's a well-known issue in the trade literature. And so we kind of follow some recent work by Adrien and Chenzi on developing a midpoint growth methodology that has some attractive properties, but I'm going to skip over this in the interest of time, and it doesn't matter for any of our empirical results. Now, let me just say, what's the identifying assumption here? And this will be similar when we turn to some other exercises. It's basically the standard parallel trends assumption. So we assume that treated and control groups, so those that received more or less EXIM support in the pre-period, would have evolved similarly absent the shutdown, conditional on controls, which in our set is especially means the fixed effects, which are absorbing a lot of the variation here that you might be worried about. And so that does not mean that we are assuming all products would have evolved similarly, for example, because we have this treatment defined at the product origin level. And so, to be clear, This does not mean we assume that it's random who receives EXIM support. We do not assume that the shutdown is completely random. The only thing that we're kind of, worried about that we want to take out are those kinds of fixed effects here at the product destination time level. And so a threat to identification, just to give you a sense, is, for example, any kind of US product level shock that coincides exactly with EXIM product support and does not happen in any other country, right? And so we have a little bit of firm level evidence as well that I'll show you that kind of relaxes this assumption, and you'll find very similar results. Okay, so let me show you first the baseline pattern. So this is our estimate of the effect of the EXIM shutdown on US exports. So what we can do in this specification is to basically run a dynamic version where we interact this EXIM intensity measure with dummies for the individual years. So standard difference and differences event study. And what you can see is that whether we put in these origin and year, product year fixed effects, a relatively light specification, or we continuously add in additional fixed effects, we always find that there are essentially no pre-trends here, in the sense that whether or not a product received a lot of EXIM support did not really matter for the trends in exports before the EXIM shutdown. And then this is followed by a progressive decline in export that continues all the way to 2019 here, the end of our sample period. And so just to give you a sense of kind of the elasticity that we estimate here, it's around -5, meaning that a 1% higher reliance on EXIM support in the pre-period is associated with a 5% decline in export. And so depending on the specification, we have a couple of different magnitudes here. They always range between 4 and 5. So does this kind of make sense? And like one way to think about this is that, well, if working capital makes up something like 20 to 25% of export revenues, then this is kind of the elasticity that you would expect. So this is kind of building on trade elasticity estimates that we know from the trade literature as well. We also estimate this separately on the firm level, where we have these maritime exports data, and we actually find a very similar elasticity of something around -4.6. And so what's important is that because these elasticities are quite similar, it suggests that business stealing in this context is really quite limited, meaning that if you lose exports because as a firm, I now no longer have access to trade financing through EXIM, that actually passes through almost one-to-one to the product level, to the wider US economy. And so a natural question is, well, if the EXIM shutdown had an effect on exports, does it also matter for a firm's overall revenues? Does it matter for its capital? Does it matter for its labor? And so here what we set up is a firm level regression using CompuStat data. So these are publicly listed firms, relatively large firms, but this is the data that we have. And here we can simply create a dummy variable for firms that received any kind of EXIM financing in the pre-period, interacted with a dummy for the post-period. So this is kind of a canonical difference. The difference is now we no longer have a continuous measure with a dummy variable that just says, okay, you got any EXIM support or not. What's important is that we also put in here a set of fixed effects that absorb some other variation you might be worried about. So for example, you would say, well, maybe this is something about the Trump trade wars, right? Maybe it's some exporter specific shocks. Well, for that, we put in a full set of exporter times year fixed effects, where we define exporters based in a variety of ways. And we also put in a full set of industry times year fixed effects, which absorb any kind of industry shocks that you might be worried about. And we conduct a lot of robustness and, for example, also put in other firm indicators such as, is a firm lobbying generally? Is it lobbying for EXIM support? Does it rely a lot on government contracts? Any kind of other thing that you can be worried about, we try to incorporate by always saying, did a firm rely on this in the pre-period, and then indicating that with year fixed effects. And so here's the one of the event studies, and we provide many others in the paper, where we now look at a firm's total revenues. And as you can see, similar to the pattern before, firms that relied on EXIM support or not were on very similar trends in terms of their revenues before the shutdown. Then as soon as the shutdown happens, we essentially see this decline in overall revenues that looks very similar to the overall decline in exports. And it suggests basically that, if you're an exporter and you rely on this export financing, if you lose your exports, that just means you're losing your revenue, right? You cannot simply go to the domestic market and now only send things within the United States or to other countries where you do not need EXIM financing. We also find an effect on different measures of capital, both tangible capital and intangible capital. We find an effect on employment. And in fact, the magnitudes are all fairly similar and we think fairly large. So what we find is that if you're a firm that relied on EXIM support in the pre-period, then afterwards you see a reduction in revenue, capital, employment on the order of 11%. What I think is quite interesting and important is that we don't actually find an effect on profitability of those firms. Now, if you go back to the kind of null hypothesis we were setting out initially, what that suggests is that it's not just that, if you get EXIM support, you pocket that, paid out in profits, and otherwise this has no real effects. In contrast, what these results here suggest is that it is really a binding constraint to those firms in some sense to get access to EXIM support. And they don't just kind of get a windfall profit from relying on this kind of support. Now, we provide a lot of robustness in the paper. You can find it online. I'm not going to bore you with any of these except one, which is that we also run an exercise where we remove individual products or we remove individual industries just to make sure this is not driven by some kind of small subset of firms, a small subset of products. And it turns out that there's kind of a very tight distribution of our estimates around these leave one out estimates, meaning that, it really doesn't matter if you include a particular industry or not. This is a very robust results. Well, let me then spend the remainder of my time here first on the second section, which is about capital misallocation. And so here, the first thing I want to show you is the following. So how we think about this is that we know from the empirical results that this EXIM shutdown led to a decrease in capital. And we know that it didn't really lead to a change in the profitability of those firms. And so what this is consistent with is a model where a firm's revenue depends on the capital, and then there's some kind of input cost wedge, which we call tau here, where there's an addition potential support through EXIM, right? And all of those are kind of firm specific. And so what it means is that a firm's MRPK, or marginal revenue product capital, is going to depend on the kind of EXIM support here in its marginal costs, right? That's kind of the way that we think about this. And then of course the question is, well, what are these cost wedges? What are those frictions that you believe are in a firm's revenue function? And that's something that I will return to in a minute. Now, what's important here first is that what's the implication here when we think about some firms shutting down, right? Is this kind of good news or bad news for the economy? And so just to illustrate this, let me show you a very simple graph where to try and give you a little bit of intuition, right? So what I'm plotting here is just, suppose that there's a distribution of these taus, these wedges of firms, and you have some firms that have kind of a high MRPK, so there are firms where there's a low MRPK. What I've shown you is that, without EXIM, this is kind of our key empirical result. The average wedge of a firm industry relative to other firms in industry, it increases, right? So there's kind of this real effect, which suggests that, the EXIM really is some kind of thing that reduces these tau wedges. Now, what's very, very important for the interpretation of our results is that this finding alone does not tell us anything about the allocation of capital in the economy. In some sense, it is not really sufficient to tell us about whether this support was good or bad in the first place, because there are basically two scenarios. So one scenario is that, well, if it is the case that high MRPK firms contract more, right, then you might say, well, this is kind of a real problem then, right? Because these are good firms. We want more capital to be allocated to those high MRPK firms. On the other hand, if low MRPK firms contract more, then, this would say, sorry, the other way around. If average K decreases, right, and high MRPK firms contract more. It means there's an increase in misallocation and the other way around, right? If low MRPK firms contract more, then that means the misallocation decrease. So the point here is that it really depends which firms are affected if we want to interpret whether or not these kinds of policies have a potential negative effect on the misallocation of capital in the economy. And so to estimate that in the data, we follow the estimation strategy from the Poorya Matray Econometrica paper, which builds on some other literature before. And what we do in particular is that we look at the effect on a firm's capital, not only as a function of did it rely on EXIM before or not, is it after 2015 or not, but also whether that firm's average MRPK in the pre-period was high relative to its industry. And we define that in a variety of ways, looking at where's a firm's MRPK relative to just an industry or industry size bucket. And so, at all points in time, right, we're going to be controlling here for any shocks that are specific to these high MRPK firms. What we're really interested in is the triple difference estimate, which tells us, within these kind of treated firms, is it that high or low MRPK firms are reacting more? And that's going to be informative about any change in the misallocation of capital in the economy. And so, what's really important here is that we cannot simply correlate, is the US EXIM lending a lot to high MRPK or low MRPK firms? Because if we just did a very simple comparison like that, as this existing paper here shows, you will also always bake in some kind of measurement error in this MRPK, which we know can be pervasive. So instead, what we're going to be looking at are these within firm changes. We're going to look at capital for the same firm over time, depending on the exposure to EXIM and whether it was an high or low MRPK firm in the pre-period. And so how are we going to measure MRPK? We're going to basically follow, what has been done a lot in literature, which is to look at the ratio of revenue to capital within an industry or within an industry size bin. This is to kind of accommodate the assumption here that those firms within a very tightly defined industry or within an industry and size bucket are likely going to have very similar production functions. And so here I'm showing you now the triple difference estimates, which is exactly this interaction of, what is the marginal effect of EXIM reliant firms after the EXIM shutdown if they also had a high MRPK in the pre-period. And so here we find a similar pattern to the basic diff and diff estimate, which is that those coefficients are close to zero in the pre-period, suggesting no differential trends, and then they drop in the post-period. And now when we unpack kind of this estimate, we see that actually this effect, this triple difference, is really driven by the high MRPK firms. So it's not the case that these treated low MRPK firms are now increasing somewhere their capital. It really is the case that the high MRPK firms are decreasing capital much more than low MRPK firms. And so what that suggests that at least within this set of listed firms for which we have these data, it means that taking away this EXIM support, if anything, actually increases the misallocation of capital in the economy, right? It's not the case that this was a very bad subsidy and it went to terrible firms, and now yes, those firms might shrink, but actually those firms shouldn't have never gotten the subsidy in the first place. So actually the allocation of capital in the economy improves. We don't find evidence of that, at least in our setting here, and we think that's important for interpreting the estimates. Now, just kind of to take a step back here, I think it's interesting to think about. So, why is it that private banks aren't stepping in by themselves, right? So why should this be happening? If these are such great firms that have great projects, right? Why isn't it that the private sector is already doing all the necessary financing in the pre-period? And is it the case that banks are leaving money on the table here? And we think that this is really not necessarily the case because this can easily arise in the case where there are some kinds of frictions in the economy that basically prevent banks from lending to the firms in the absence of EXIM support. And so, this could in fact be very much the kind of profit maximizing things for banks to do, to not lend to some firms in the economy. There's simple different reasons for that. Some are, perhaps, this is a very concentrated market with high markups. But, it could also reflect the structure of the market in some sense, and we can test some of that in the data. And so this basically boils down to asking, what exactly do we mean by these input wedges tau, right? What are these kinds of frictions that are might be in the economy that affect firms differently and that might make it necessary for an institution like EXIM to step in and provide financing support. And so basically what we have in mind here is that there may be two very simple types of input wedges. So one of them is a firm-specific borrowing constraint. So the idea is, well, perhaps you have incomplete contracts or you have information asymmetry. So even though they're exporters, even though they tend to be relatively productive firms, some of them might simply be financially constrained. And that's kind of well studied in the corporate finance literature, of course. The other constraint that we have in mind is an export market constraint. So it might simply be more costly for US firms to export to some markets than others. We know there are a lot of cross-border contractual frictions. It's hard to enforce contracts across borders and so on. So what we would expect is that firms that face more of these export market frictions, that they would be more affected by the EXIM shutdown. And in the paper, we find evidence that aligns, we think, quite well with both of these intuitions. The first year, if look again at firm investment, and we look at the triple difference coefficient here, we look at, are you exposed to the EXIM shock or not because you were previously relied on it, but also were you financially constrained, perhaps because of your leverage, the intensity of the dividends you pay out, or we use the Holberg-Maximovich measure of financial constraint. It doesn't really matter how you define this. We always find is that there's a larger effect of the EXIM shutdown on investment for firms that are plausibly financially constrained. And that's exactly in line with these kinds of frictions that are on the exporter side. We also look at trade frictions. And so here we look at, are you a country with a very high perceived risk? Are you a country with a problematic rule of law? Are you a country that has poorly developed local financial markets? All of those might create more frictions for firms to export there. And what we find when we look at the product level data from DataMind, this maritime export data, that it's exactly these kinds of frictions that seem to matter. It's exactly these types of exports to risky places with poor rule of law, with poorly developed financial markets that drop more after the EXIM shutdown. Now, let me just spend perhaps 1 minute or so before we open it up to questions on kind of thinking a bit more broadly on, what does this mean when we think about these export credit subsidies, right? What does it mean when we think about export credit agencies? And so far, basically what I've shown you is that this EXIM shutdown had an effect on average output, and it had an effect on the allocation of capital within industries across firms. And now, of course, the total overall effect of these export credit agencies will really depend on how any given agency interacts with the rest of the economy. And so the three questions that we're interested in here is, number one, is this maybe very costly to taxpayers, right? Do you need to raise all sorts of distortive taxes to get these kinds of programs going? Number two, is it that EXIM perhaps crowds out the private market, right? This is a case of, more government intervention is actually crowding out private activity. And, perhaps, this more broader question, how does this relate when we think about more generally about industrial policy? Now, the first point, what we find when we look at EXIM's income statements is that in general, its revenues tend to cover costs. So, annually, typically it returns around $500 million to the Treasury. So, this is not only because it operates within this tight corset of institutional constraints, but also because it actually earns quite a bit of revenue on, for example, its insurance products. And so, why is this? Why should this be the case in general that, it makes any profits? Well, you can think about this as the fact that perhaps being the United States and the debt being agency debt, especially to developing countries, might make firms in those countries kind of an incentive to pay back loan if it is somehow backed or insured by the US EXIM. And so empirically, that's why we see that EXIM has a low default rate and high recovery rate. It might also be because EXIM perhaps sets lower markups relative to what a private sector lender would, simply because they kind of have the amount of exports in their mandate, and as such, it might be kind of in their objective function not only to make profits but also to increase exports per se. And so what these findings suggest is, well, they're profitable, there are reasons to believe why they might be profitable. So it suggests that you might not actually need to levy some kind of distortive taxes to finance export credit agencies. So does it crowd out private banks? We think that this is not necessarily the case because, in fact, applicants to EXIM support usually must provide evidence that they were unable to secure financing for a particular transaction from the private sector. So if that is correct, then what that suggests is that EXIM, by definition, does not cream skim. By definition, it doesn't crowd out because they always have to prove basically that a particular exporter could not finance a transaction in the private market. And so, another way to think about this is that there's almost perfect market segmentation between EXIM and private sector banks. Another limitation here is that actually EXIM cannot, just expand into infinity because they cannot accumulate profits. They have to be remitted annually to the US Treasury, and the annual balance sheet size of EXIM is also actually mandated by Congress. So here, the last point, so how do these interventions relate to broad industrial goals? What we think here is that, well, if we think about industrial policy as targeting some kind of social wedges, whether they're industry, market, or dynamic wedges over time, as long as they're kind of positively correlated with these TAOs as we think about them here, that means that EXIM actually targets these kinds of objectives, right? They can both, for example, alleviate financing constraints and overcome some of these trade financing frictions. And so I think there's a lot of more future work to be done here, but let me just conclude by saying that we provide some evidence here that export credit agencies have a causal role to play when you think about the real economy. We show their large average effects of the EXIM shutdown, maybe more importantly, their allocative effects across firms, even in the context here of a country with highly developed financial markets. And we look at large publicly listed firms for those misallocation results. So you would imagine that those effects are somewhat larger in other contexts. And so what that really suggests is that because international trade entails a lot of frictions on the financing side and on the cross-border contractual side, perhaps it really is the case that private markets are suboptimally under providing credit, and there might be a role for government intervention there. Let me just say thank you very much, for this. And I think there's a lot of interesting questions that I'm curious about. What is the best way to design these interventions? How should we think about them in a broad industrial policy context? Any questions are much welcome.
Thank you very much, Karsten. Fantastic, fascinating paper, and very clearly presented. Wonderful. So, yeah, the floor is open. If you have a question, just come in, raise your microphone, and just join the discussion. I have, of course, also some questions here, but let's try to see whether there's anybody who dares to break the ice. As usual, in Zoom, not always easy. Okay, we have a question by Thilo Kröger. Please come in. Just, I think you should be able to just unmute yourself.
Now it should work. Hi, Karsten. Hi, Christoph. Very interesting paper. Actually, I'm working more or less in that realm of ECAs as well. I do have a question. I was a bit puzzled that you find virtually zero effect on the low MRPK firms. And I was wondering, well, is it if the majority of those firms never really applies for EXIM. Because I mean, to expand a bit, from my understanding and what you've iterated in the later parts then is that, well, EXIM would support exports to risky countries. It might support, and that's kind of what your results on the high MRPK firms hints at. It supports the more productive firms that are somewhat too small, as indicated by their too high MRPK, so they should be larger in the optimum. So it supports those more productive firms to exit more, to enter more markets. And the question is if those zero effects, maybe because those firms, even so the lower MRPK firms, would never want to enter those more risky markets where it's more difficult to obtain finance.
Right. So thank you so much, Thilo, for the question. I think it's very interesting. So I think that let me try and answer it in two ways. The first is how you want to think about this comparison is not that we are comparing low MRPK and high MRPK firms per se, right? We're always looking at within the bucket of treated firms. So within the firms that are already relying on EXIM before, within that bucket, it is that we're comparing high and low MRPK firms, right? So what we're capturing basically is not the fact that, our low MRPK firms may be, less interested or less, willing to engage in transactions that would require EXIM financing in the first place, because by definition, right, they already received EXIM financing in the pre-period. Right? Now, that said, I think it's a very interesting question here. Why is it, right, that some firms are kind of selecting into, wanting to or requiring EXIM support, perhaps, as I say, but because they want to do something, right, that is maybe hard, but profitable and productive, right? And the problem here, I think, is just empirically, it's not that easy, I think, to study that, basically because it's not trivial to measure these things, right? So we can measure which firms receive this kind of receive the support, right? But we don't necessarily see, for example, what about all the firms that are securing trade financing in the private market to have kind of a counterfactual there, right? We're already seeing this very selective sample. So, but I think it's very important to think about this, right? Which kind of firms are actually relying on this kind of support.
Great, thanks. More questions from the audience. So otherwise, I would use my privilege as host here and ask a question. I have several, actually. Maybe let's start with the kind of a bigger picture question. So your presentation very much sounds like a love letter to export credit agencies, right? So essentially, there's a market failure here. The export credit agencies are very successful in fostering exports and international gains from trade. So what's kind of like I'd like to push you a little bit on the so you go to Berlin or Brussels or Washington, what's your recommendation? What do you suggest? I mean, you had this very last point, like where you caveat, like what's the best? We don't know what the best intervention looks like. Okay, granted. But so should we infer from this that we need more export credit agencies? Was it the big error to shut this down? What should Germany, for example, do, or these other countries that are currently struggling with exports? How does it compare to China, to other global South powers that are quite likely using this much more actively? So yeah, what do you say about kind of the bigger? How does your paper speak to the bigger discussion of industrial policy and use of these tools?
Yeah, well, thank you, Christoph. I mean, let me start maybe by saying that I would push back a bit against the love letter evaluation, okay? And for the following reason, what we're trying to do is we're trying to think about whether there's an economic rationale here, right, to provide this kind of programs, right? That doesn't mean, for example, that they're welfare improving, right? So by definition, everything that I've shown you is going to be some kind of difference in differences estimate, whether, sometimes we can get more broad, right, on the product level, but, there's a lot of things that could go wrong, right? Even going from our estimates to any notion of welfare, right? All we're trying to say is that there seems to be some economic reasons why it could make sense to do this. And it seems to have bite in this very particular setting, which is also an extreme setting, right? Like you literally shot this down to 0, right? Now, what does it mean in general about export credits? I think the devil there is really in the details, where basically every country has a completely different program, right? So, for example, one question is in Germany, because I mentioned it, right? There's Euler Hermes, right? That they are providing these kind of guarantees, but that is actually a private company, right? So there's also other very big players in the trade finance space that are actually not public, right? They're actually private companies. Some of them affiliated with ECAs, some of them not. And so really, right, the kind of counterfactual you probably want to think about is how well are those private companies doing this relative to the ECAs, right? I think that's one factor. And I think the other factor is that there might well be non-economic reasons why sometimes you want to make sure exporters are involved, right, in trade with a particular country, not because that's the best country to be exporting to by any, for any economic reason, but perhaps you want to initiate trade relations. Perhaps you want firms in that country to be dependent on exports from your country, right? So all of those could also, have something to do with how these ECAs operate in practice, right? It's like, by definition, this is a very political field, which I think is also the reason why it's exceptionally difficult to find good data on what they're actually doing. I think that's not a coincidence.
Yeah, no, I agree. The lack of data. So it's amazing how you exploit this Freedom of Information Act data set. I mean, this is unique. It's a gold mine, right? So and picking up on your last point, this is very political, and you might use it to open up, like government being the door opener to the private. So following the flag. Have you looked at this? Will you be looking at it? I mean, it's hard. But do you see where is this going, and is there a way to test for these strategic motives?
Yeah. No, so thanks for asking this as well. So I think there are really two separate problems here, right? So the first problem is you first need to be able to measure what is going on in the export credit market, not just, okay, here's one number globally, this is how big the market is, but how involved is any given country with other countries, right? So there's just a measurement challenge. And basically, I've spent quite a lot of time on this now. I think it's possible to construct estimates, but it's not trivial. And basically every source, everywhere you turn, there's some big caveats. Okay. So I think that's really something that I think it generally needs to be done in order to say something about this topic generally, and maybe also to establish, right, like just the quantitative importance, right, of it, especially when you think about industrial policy goals and so on more broadly. Now the political part is something that we're working on, because what we're really interested in is to say, I mean, especially if you think about this shutdown period, basically, it coincides pretty strongly with a slight uptick in export credits provided by the Chinese ECAs. And so, that we think that's also not a coincidence, right? So basically what we're working on right now is kind of a cross-country extension in some sense, right? Where we're trying to understand not only the size and trends and, the directions, dynamics of this market as a whole, just more thoroughly than I think others have looked at so far, but also to exactly look at the kind of competition, right? There's a geopolitical competition over these credit programs, right? But I think it's possible, and I think we're we've made some headway on this recently. So there's going to be more stuff coming.
Great. Sounds like a very exciting agenda. So I'm tempted to ask 7 more questions, but let me ask around if there is others who want to come in and ask a question. Right. So let me just, I mean, I don't want to overstretch this. We're already a little bit beyond the 1 hour. But I'd be curious to understand more on the country destination. So where is this going? And has this so especially on this geopolitical, you haven't, I mean, in general, like you have all this granular data, but most of this, most of the results you show were basically these average effects. So I wonder, what's the most just from curiosity, what's the most fascinating stylized insights that you gained? What were you surprised about? Is the US entry, like how important is Africa in this? Or you mentioned developed countries a lot. And did maybe these fringe countries where the effect largest for, say, you made showed these interaction, but like just the quantitative effects of the shutdown, where did it hurt most, right? This is kind of
right. Yeah, I think that there are 2 points, I think. One is that one of the really quite strong predictors of the amount of EXIM support relative to, say, exports, right? So kind of the intensity of EXIM support. And one of the strongest correlates is just any measure of political risk.
Interesting.
Okay? So it really is the case if you look at all the destinations, and basically this EXIM support goes to almost every country. I mean, it's really quite widespread. It's not concentrated in kind of one or two countries only. And this is a very strong predictor, right? So, and this is exactly, of course, this is kind of baked into the mandate, because what the 2 risks that are really being insured against, right, are political risk and some kind of commercial risk. And political risk, I mean, in practice, right, it means that the state-owned company that you're shipping something to, right, they wake up in the morning and they say, you know what, we're not gonna pay you back, right? The president called, we're not paying you back, something of that sort, right? And so the second point, I think, is changing trends over time. And where's this going? I think for this, the loan level data simply has too short of a time series in some sense. So what we're actually doing now is we already digitize quite a lot of the annual reports of the US EXIM, and we also look at other countries where we have some, I think, pretty unique data as well. But there you can really trace kind of the long-term changes, right? And I think that's going to help because there have been big shifts in the geopolitical situation, of course, right? If this data goes back to the 1930s, right? So a lot of stuff happened, and so that's exactly what we're working on right now. Kind of correlating changes in political alignment with different countries with the amount of support that you receive.
Fascinating stuff. Very promising. Cool. Great. I think we're over time. Unless there is a hand jumping in the next 10 seconds, I would conclude today's session. Let me thank Karsten again for an excellent presentation, for coming in late at night. And I wish you a wonderful evening, day, wherever you are, night. And with no further ado, I'll see hopefully many of you in a month with Oleg Itskoki as the next presenter in early October, first Thursday, always at 5 p.m. Central European time. All right, Karsten. Thanks to everybody, and have a great day. Bye-bye.